So I want to thank everybody for attending today's session. I'm joined today by my friend Mike Egan, Gyroscope Capital Management. He's in from the west coast of Florida today, and I'm trying to expose him to Art Basel, Miami, which is my favorite time of the year. So Mike, why don't you take a moment, introduce yourself, and tell us a little bit about your background on Wall Street and where you got started and what your experience has been.
Michael, I'm happy to be here. I'm all the way from Naples, Florida, which for those of you who are not conversant with Florida, it's only about an hour and 45 minutes due west, but it seems like a different planet relative to Miami. It's an exciting time to be in Miami, and I'm very happy to be here now for this week in Art Basel. I started my career in 1990 in New York City, working as you did for a very large investment bank. I started on the fixed income derivatives desk, the institutional fixed income derivatives desk. We had clients like American Express and Ford Motor Company, and we would help them swap their fixed rate debt for floating rate debt, or the reverse, depending on which was more cost effective. I was very fortunate. I had a number of great mentors who helped me understand how options worked. And that was really the genesis of founding Gyroscope Capital, was how do I bring these impactful strategies of hedging underlying securities or selling call options or options to generate income? How do I bring that from the institutional side to the retail side?
So what made you start Gyroscope Capital? Why did you begin it?
You know, if I try to bring it down to two easy points. The first is there are a lot of individuals and families who have way too much in one stock, and they don't really know what to do. And often their advisors are trapped in their own minds. How do I help? I don't want to sell and realize capital gains, yet I really don't want to have all this exposure. That's the subject for a webinar we're going to do next month or in February. The other side of options that I get really excited about is their ability to generate significant income. If you own a portfolio and underlying of almost anything, whether it's stocks, bonds, et cetera, and you sell covered calls, more often than not, the option you sold will expire worthless, and you get to keep that premium and put it in your pocket. In other words, especially for an equity portfolio, which we're going to talk about in a little bit, you get paid to wait for your underlying stocks to appreciate.
Okay, so today, facing baby boomers and their advisors, what is the problem that we have to deal with as far as society is concerned? What do advisors have to think about? What do baby boomers who are retiring, in record numbers, what do they have to think about?
Oh boy, you've got two major issues in our opinion. You've got demographics and you've got lack of alternatives. Let's talk about demographics for a second. I have a study in my head from the Pew Research Center. They just did it at the end of last year. 3.2 million Americans retired last year. 3.2 million more than would have retired had in the predicted flow. That's a lot of people who now need to replace their wage income, their W-2 income, with portfolio income. So you have a lot of demand. On the other side, you have a lack of supply or a lack of alternatives. The 10-year US Treasury is below 2%. I think on my way over here, I saw it's below 1.5%. We've all been trained in our investment management careers that the gold standard is a 60-40 portfolio, 60% equity, 40% bonds, where the bonds, the fixed income, are providing the ballast to the growth part of equities. Well, if bonds are yielding 1.5% on the 10-year US Treasury as a comparison, does that still work? I don't think so. And even if someone were to say, okay, well, interest rates are going to go up, we have the chairman of the Fed telling us so, I believe him. But what are they going to go up to? If 2 years from now they're at 2.5 or 3% on the 10-year US Treasury, does that solve the problem? I don't think it does. And then compare that to if I have a portfolio of equities that have a 3% dividend, and then I'm adding another 3% in covered call premiums. we're talking about completely different ballgame, a way to mitigate, if not solve the problem.
So you have a demographics problem.
Yeah.
There's a lot of boomers that are retiring, and they need to replace their wages with portfolio income.
Right.
They go out to the market, they start to look around for fixed income type securities to replace that income, and it's not there. What are some of the alternatives?
Well, any income providing investment could be an alternative. I could have public or private real estate, REITs, MLPs, bonds, and all kinds of flavors of bonds, right? I could go from short duration US treasuries to very long duration emerging markets or I really want to take that risk, I would suggest that you don't. So if your thought process as an advisor or as an investor is, therefore, I should stay on the short end of the curve, stay, say, a year or less with very high credits, gosh, you're going to be 3% or less on your best day. I'm not a fixed income expert, but it's a pretty low number.
So what are some of the options that you have available to you with publicly traded securities? What does Gyroscope do?
Gyroscope does two main things. We talked about hedging, and we'll get to that another day. Equity income is our specialty, where we have three separate portfolios. We'll talk about one of them in particular today, where we are identifying, in our opinion, the best securities for a particular investment objective. And then we're selling covered calls on top of that to generate additional income. I'll give you three examples. Our dividend income portfolio is made up of 20 US large cap value stocks. And we can go through the security selection process in a little bit, where we are within plus or minus 5% of the industry sector weighting. In other words, we're not taking any sector bets. We have no sector bias, if you will.
So you're not trying to outsmart the market.
We're not smart enough to outsmart the market.
You're not trying to outsmart the market, but you're trying to pick up alpha through security selection.
Correct. We're buying stocks that we feel will appreciate in value, that are undervalued today. It's a great way to say it. And then, well, I should start with one of the security selection criteria is that the portfolio must yield 3% or more. And we're hyper consistent historically in being able to do that. So we start with 3% in dividends. Okay, 3% is about what we just talked about for the best fixed income that we might want to invest in. In addition to that, then we're going out and selling covered calls on most, if not all, of securities in the portfolio. This is very different. It's one of our value adds. Instead of just selling index call options on the S&P 500 or the Russell or the EFA, we're literally selling options on each individual security. And that generates a target of additional 3% per year. So 3 and 3 is obviously 6. That's our first portfolio.
So how have you done meeting that benchmark since the inception of this strategy?
Our official inception date was October 1 of 07.
Okay.
We started selling covered calls in May of 2010. So what I just described, I think probably more appropriate to say, let's look at it since the day we started that in May of 2010. So that's what, 11 and a half years ago?
Okay.
Some days it seems like that was 10 seconds ago. Some days it seems like a long time. Hyper consistently, 6% or better. That's our target. Now, to be clear, there are some quarters when we might be at 5.98%. It's not a straight line 6%. I'm going to give you an example. In March of 2010, the world had stopped because of COVID. We all experienced it. With US large cap value, any client or investor or advisor who keeps their eye on the markets knows that US large cap value fell off a cliff. And so we were left with a portfolio that we loved, that we felt was undervalued when we bought it. Now we thought was considerably undervalued.
Right.
Why would we ever sell a covered call which would cap us below what we thought was the intrinsic value of those securities? So we were very careful. You may remember volatility went through the roof. We would sell covered calls at a rate or a call strike price where we felt comfortable it wasn't going to get there during that time period. but we still were able to earn almost 3% on an annualized basis. And we started selling them shorter and shorter. So our average covered call sale, let's assume, is in the 90-day range. So it's 4 times a year. We were down to 30 days, and we were still covering that premium obligation. Now, what we could have done is to say, gosh, well, let's take all that income. Let's earn an enormous number, not 3% annualized, but 8 or 10% annualized. Those opportunities were there. But now we would have capped ourselves out in the portfolio, which is the first step, is we invest in stocks we like, that we think will appreciate.
So you're investing in stocks, badge value, large cap, writing covered calls against them. It's a concentrated portfolio.
Correct.
But it's diversified from a sector perspective.
Correct.
Talk to me a little bit about how you achieve this sector diversification.
Well, that almost sounds like we contradicted ourselves there, right? You have concentrated, but you have diversity. It's easy to go out and buy the 500 stocks in the S&P 500 or buy 250 of them. We don't really feel like that's adding value. Maybe achieving other objectives, but for us, for Gyroscope, we feel that to add the most value, we need high conviction stocks that we feel will appreciate. So we're not buying 10 in a particular sector, we might be buying 2. And those are the 2 that our security selection process designates as the most robust candidates for principal growth, instead of the easiest way. So I really want to only have, or we as a portfolio management team only want to have 20 stocks. On the other hand, we don't feel that we're smart enough to outsmart the market, as you and I are talking about. I wish we were, but we're not. So we have a rule, especially for dividend income, that we must be within plus or minus 5% of the S&P industry sector weighting. So we can't be more than 1 stock. Remember, 20 stocks at inception, so that's 5% each. I can't be, or the portfolio can't be plus or minus more than 1 stock above or below the industry sector weighting.
How dynamic is the model? How fast does it change, turnover?
I like to think that our portfolio managers get some sleep at night,
Okay,
but otherwise, that's all they think about.
that's all they think about. So they're tweaking all the time.
They're analyzing all the time. Now, with a concentrated portfolio, just because your number 1 stock a week from now is the number 2 stock, it doesn't mean that you want to sell it. We are tax aware, but we're also patient. This is a value portfolio. And on any given day, we can even talk about just this week. What day is today? Thursday? I mean, this week, we could have made 7 or 8 changes in a 20 stock portfolio if we were quick to pull the trigger. We're patient. On the other hand, we have very robust sell rules that there's a time when you have to give up.
So I'm an advisor. I have a RIA and I'm looking to invest into your strategy. How do I go about it? What types of structures do you offer? How would I go about investing in this strategy?
Right now, we are available via SMA, separately managed account, through a whole host of custodians, TAMPs, and avenues to get to us. I'd encourage any advisor just to email me or call me. I know my information is going to be somewhere on the screen at the beginning or the end.
Sure.
And I'll walk you through the path that either we already have built or we'll build one for you. We're also strongly considering a pooled vehicle for advisors who may prefer ETFs, mutual funds, and the like. So if that is of interest to a particular advisor, let us know so we can come back to you when that's available.
Sure. Let's get back into this income thing, because I feel the income portion of the conversation is something that everybody is dealing with, whether they like it or not. Rising. How does inflation factor into whether you want to be in equity or in debt? Security.
Well, from a big picture standpoint, equities, in my recollection, have outperformed in periods of higher inflation. Now, you can pick a period where that didn't work, but if you have a fixed income portfolio and inflation rises that is not good mathematically for your fixed income portfolio. I think we
Not here to
throw stones at
debate that,
our
right?
fixed income brothers, because I
Okay.
used to do that at Lehman in the old days, and I love the fixed income side. So of course I'm going to be biased towards the equity side.
No, but I mean, it's obvious the inflation would definitely like destroy the capital side of the equation, the principal.
Agreed.
on the
Agreed.
Fixed income.
Yep.
So,
Now, if you go into a dividend portfolio, issuing companies have the ability to increase their dividends in any environment, but perhaps would be encouraged to do so more vehemently by investors in the environment. That's not going to happen to fixed income. They're not going to just hand you a higher interest coupon one quarter because, or one half of the year because inflation has gone up. So dividends can rise and may or may not be expected to. But as inflation rises, historically, interest rates rise. And without diving too far into the Black-Scholes option pricing theory, interest rates are a component of option pricing. In other words, everything else being equal, as interest rates rise, the premiums which you earn for a covered call premium sale will rise. So if you looked at just that one little piece, you'd say, I want to be selling covered calls on something and be paid more and more as I wait for my portfolio to appreciate.
well, this sounds like a no-brainer for a portion of the fixed income book is to diversify into, dividend paying stocks, writing covered calls, right?
Well, yes and no. I want to
Okay.
put a caveat on that with, these are equities that we.
Tell me the contrarian view
Right.
on that. Why no?
Because you still own underlying stocks, right? So if I say I take a 10-year US Treasury bond, I know in 10 years I'm getting back my original investment plus, as we discussed, a minuscule interest. I'm certain I'm going to get my principal back. If I buy stocks, there are periods where 10 years from now, I might not have as much. There are very few, but they exist, right? So these are equities, no matter how conservative we might debate they are, you have principal risk on a daily basis. All that being said, how often can an investor afford not to have the opportunity to earn additional income from covered calls? In other words, the income that's coming in, will that mitigate any potential loss? Sure, but you still might look at your statement one month and see a lower principal value.
I'm going to make a contrarian argument to that.
Okay.
So as a fixed income investor, if inflation's outpacing the yield on the 10-year Treasury, I'm actually losing money.
Agreed to that. Agreed to that.
Right? So this is a way to keep up.
I completely agree. The challenge you and I face with that argument, or any option specialist faces, is that on your monthly return, your monthly statement, it doesn't show you an inflation adjusted value of your portfolio. So to your point, you're not going to see a mark to market on your bond showing that you lost money versus inflation. But mathematically, what you just said is absolutely correct. And I would encourage advisors to walk them through it, because that math is very robust.
So I'm thinking about dividend stocks. Obviously, it's nice to know that a company did dividends. Do you have any of your analysis that looks at the consistency of dividends or dividend, growth, or like how do you
Great question. The security source of 500 stocks plus is too much for us to analyze. So to narrow it down, we apply two first, that question must have a dividend today of at least 90% of the S&P 500 dividend. So if the S&P is at 2%, you have to have a 1.8% div to get in. we found that by removing stocks that have reduced their dividends, we are now really focused on income.
Talk to me about free cash flow.
Our apply 4 factor screens. My favorite is price to free cash flow. Now, again, this is a dividend income portfolio. So we, of course, want to buy stocks that are going to increase their dividend over time, right? If they decrease it, they're out. But the company can just sit there with its dividend. We want them to increase it. We want our investors more. Not only do we want them to get paid more on some stocks that might have a 2.75% dividend that we feel growth. So the portfolio needs to be 3%, not each individual stock. Price to free cash flow, we don't want the underlying companies to borrow to pay a dividend.
Right.
We want them to have a lot of free cash flow. The less we pay per dollar of free cash flow, the happier we are.
Well, it's brilliant. You're basically selecting stocks that are going to pay their dividends, that you're going to generate income. You're going to be writing covered calls against those positions while you're waiting to collect capital appreciation.
Correct. Now, in a value portfolio,
it may not be the most sexy stock
in
the world.
Correct.
Right?
Correct.
So it's boring sometimes, correct?
You've heard of every name. It's an average market cap of $90 billion. Advisors will know all the names. Investors will know all the names. And patience is key for that second part, for the capital appreciation. But yes, you get paid to wait.
In boring names.
In boring names.
That represent the entire economy.
By definition, we have to own at least one stock in each of the 11 GIC sectors. And as we talked about, we have to be really tight to the sector weighting.
While getting a concentrated book.
Correct.
That really is amazing. I love it.
Thank you.
I love what you're doing. You're basically taking all the options that you have available to you. You're de-risking it. And I would also make an argument to, there's a publicly listed equity premium that's obvious during times like March 2020. It's nice to have publicly traded securities that if you need to liquidate them for whatever reason, you can, right?
Can be out in 10 minutes.
And some of those fixed income securities, you weren't able to unload them as well when times got really tight.
Right.
A lot of these positions, people were, not accepting any bids or offers. So being in this could be also considered another way to de-risk the fixed income portion of the book.
Agreed. Some advisors have come to us and said, and we're not here to provide macro asset allocation advice, but some advisors have come to us and said, what you just did, hey, I can't earn enough in fixed income. I really don't like the liquidity constraints that you just described quite eloquently. I'm going to hold a lot more cash or very short-term investments in fixed income for clients, investors, and I'm going to allocate considerably more to US large cap value through your dividend income strategy because I do have a patient investor and I've got maybe 2 or 3 years worth of spending needs in cash. So I don't really have to be near the panic button if I have a March 2020 event.
So where should investors be looking for today inside their portfolio to reallocate to a strategy like Gyroscope's dividend income plan?
Well, big picture, Polly is coming up. Maybe that's a time an advisor or an investor to look at your portfolio. Everything in your portfolio. Hey, did I in 2021 to cover my needs? And if I did, does it make sense to me to think ahead? Either I really have to cut what I'm spending, or maybe it's time to start migrating towards a higher income and more consistent income providing investment.
So that sounds like an excellent play for people who still want to have a more active lifestyle, have a higher level of income, they're not ready to throw in the towel yet, is, look to this value portfolio of dividend stocks where you're writing covered calls. You're doing the hard work for them, not only on the security selection side, but also on the covered call writing side. There's a lot of work that goes into it.
There is a lot of work. I'm blessed. I'm the one you're talking to right now, but the really smart team.
So talk to me about the investment team. Don't only tell me, tell the rest of the audience that's tuned in today. We didn't cover a team.
We didn't. Let's go through that real briefly. Thank you.
Talk to me about your team.
Yeah,
this isn't a one-man show. This is
this is not. You've got the least of the value of the firm here. There are two of us who face advisors and clients, myself and Sarah Wolf. We worked together since 1995 and very fortunate. She started Legg Mason when I was there. On our portfolio management team, we have two portfolio managers who spend all of their time facing the portfolio or analyzing the portfolio. Rob Carr joined us in 2008 and is a chemical engineer by training, may be the single smartest person I've ever met. And I really do think he dreams about the portfolio. He's a CIPM, so is particularly skilled at articulating performance measurement. His colleague, Anthony Cirillo, is a CFA charter holder, also incredibly intelligent. And I know that he dreams about security selection over the weekend and while he's fishing, which is his favorite pastime when he's not working. In addition, if Anthony were here today, he would want to spend the entire time discussing how he is so careful to get the best absolute price he can on each option sale by being patient during the trading day. Wouldn't it be easy just to say, hey, I own a bunch of ABC stock, I'm just going to hit that bid and be out of here? It would be easy. But if I can get, or Anthony can get, a nickel or a dime more per option sale, 20 stocks, doing that at least 4 times a year, that's an enormous increase in the amount of premium that the investor is going to realize. And the investor won't see it, right? Because they don't see limit prices. They just see the amount of income coming in. But I know at some point we should probably have Anthony on to have him describe this with you.
Absolutely. Absolutely. It'd be nice to get into some of the stuff. But going back to the team, you have a team. It's been with you for a long time. Congratulations on that.
Thank you.
Right. That continuity speaks very highly. How did you do it? How did you, keep a 20+ year track record with some of the members on your team?
Well, just to be clear,
Yes.
October 1 of 2007. So that is not quite 20 years yet, but we can.
You worked together before that.
That's correct. That's correct.
These people must have liked you.
So far, so good.
Yeah, you're doing a good job, obviously, right?
Yeah, Sarah has been with me, and we've worked together since 1995, which seems like several lifetimes ago.
That's a long time.
She's a very patient person. And Rob's been with us since 2008. Anthony, I think, is now 4.5 years. It's a great team of people that work well together. We have our intra-family squabbles like everyone else, but part of the reason we have squabbles is that each of us adds value in a different spot, right? So you have a very linear thinker talking to a very trading-oriented thinker. And then you've got two relationship management people who are saying, hey guys, that's brilliant that you just did that, but now we need to translate that back into English to describe it to the average investor who is smart enough to understand options, but doesn't think that way.
So talk to me about customer service. I'm an advisor. How are my clients going to be treated by Gyroscope? How are they going to be handled?
Well, the advisor opens the account. And again, I'm happy to talk to any advisor about how to do that. And we'll go as far as we're allowed to in terms of the forms you need and the best path and the paths available to you. You can probably tell by now, or any advisor or investor can tell, I love to talk about this stuff. So if you are an advisor and you think, hey, I wonder if I can get someone on the phone from Gyroscope to talk to my investor about what happened last quarter, what they're seeing in the market, what do they think about COVID, or
you're available. You're not.
Call me on the weekend.
Yeah.
I mean, I'll pick up and talk to you. This is fun.
That's great. That's great. So customer service driven firm.
Yeah.
What's the plans for growth?
We're very fortunate. We are recently been added to several very large broker-dealer RIA subsidiary platforms, almost categorically through Envestnet. And we have the first several accounts with each. So the future is very rosy. We're just very fortunate to have that opportunity, and we appreciate every advisor and every investor.
That's amazing. I really appreciate you taking the time and coming here into Miami during Yacht Basel and spending some time with us at Flya and in the office. And it's been excellent to have you here today.
Michael, it's been a pleasure. Thank you.
Yeah,
Really
thank
appreciate it.
you very much. It's great to have you today.
Thank you.